All right, welcome everybody. Hey, it's right at 2 o'clock. I try to be pretty prompt here. I'm gonna give us a few more seconds to allow some other people to enter. I appreciate you being here today. We're gonna do another chapter of the Drew 2. And if you don't know, Drew 2 is about real estate investing. So today we're gonna cover lending and basically what you need to know as a real estate investor and loans. So we'll give it a couple more minutes here for a few other people to join, and then we'll get to moving. All right, and some quick ground rules just in case. I'll keep everybody on mute until the end. It's just me. I don't have a team here. I'm not selling anything. I don't have a big team behind me, so it's just me. It just helps me navigate it a little easier to keep everybody on mute. And at the end of the presentation, you can of course unmute yourself to ask questions and everything. If you do have a question, jot it down. It's probably a chance somebody else has the same question, so please feel free to ask it. All right, let's go ahead and get started if you don't mind. So this is Real Estate Investing 101. This is part of my presentation of the Drew 2. Every 2 weeks at 2 p.m., we will do a 22-minute presentation on some sort of real estate investing topic. 22 minutes does not mean that you'll become an expert in the field, but it should give you some basic concepts so that you can understand and know where to go from here. We're just trying to give you some understandings about the methods of real estate investing and how you can get better at it. Okay, so today it's about lending. And why lending? Well, lending is the biggest partner you're going to have. 70%, 75%, 80% of your deal is taken up with a loan. And then it's a 30-year loan. That's longer than most marriages. There's no partnership that takes up 80% of my deal except for lending, and they last a long time. So they're kind of important for us to understand. So we'll talk about how we use loans, how they can benefit us, how can this presentation make me more successful as an investor. We'll hit all those things. All right, so let's get started. So the Drew 2. Who exactly is Drew? Well, I'm Drew. Andrew Postel is my full name. I'm a vice president of mortgage lending. Guaranteed Rate is the company I work for. My phone number is 817-380-1913. You can call me anytime. There's my email. Reach out. I'm a real estate investor. I'm a real estate investor with 20 years of experience. So I invested during 9/11. I invested during the housing crisis. I'm investing now. So it doesn't mean that I know everything, but I know a few things. And the proof is always in the pudding. Just because I have experience doesn't mean it's good experience, but I think that you'll find that some of this information will be helpful. I'm also a lender. I'm in the top 1% of the whole country. I can lend in all 50 states. And when I speak to when I speak to investing in real estate, I'm talking about residential real estate. All right, investing in warehousing is cool, but we speak to residential real estate investing, 1 to 4 units. Anything over 4 units is commercial in nature. All right, so residential is what we mean, and a buy and hold, meaning we're keeping our properties to rent them. So the types of experiences that I've got are rehabbing properties, tenant screening, identifying lenders, that's what we'll cover today, et cetera, et cetera. So these are the types of questions I can answer and help you with. The other part too is that this presentation will be 22 minutes in length. So I do a shorter information every day on Instagram and Facebook, 2 minutes or less. So it's even quicker for those platforms. So you can just check me out, get back to your daily routine, grab a piece of information if you want to in those platforms as well. All right, I want to get us all on the same page. It's the same thing that I always talk about. Why do I talk about investing in real estate specifically? It's because I earn income in 3 ways. Some of you might know these, but just hang tight so we can all be on the same page if you don't mind. Number 1, I make cash flow on my properties. Cash flow, I make the income, it's the rent. Now I have to pay expenses, right? Expenses go out, and the difference is my cash flow. That's the income that I receive on a rental property. The second way that I make income on residential real estate is through the appreciation of the asset. You know, real estate goes up in value. Maybe not every year, but we've got a 5,000 year history to it. It's a pretty stable asset. It goes up usually, and over time it has shown that. And then the third way that I make income is from the principal buy down. All right. So if Andrew was good enough or wealthy enough, he'd just pay cash for all the properties, right? We all would, of course, sure. But who's got just millions of dollars laying around? None of us. So what we do is we get loans. This is a normal thing. We get loans. But every time that my tenant makes a payment to me, my loan balance goes down. And why is this important? Well, let's say instead of my appreciation going up, what happens if my appreciation just stays stagnant? Well, if it does, my loan balance is still going down. Yeah, that's how I make money. I build equity. So even if I lose one way of these three, I still have the other two that help me become a successful real estate investor, and I still earn income. And as always, I'm going to present the other side of the coin here. So if I own a stock, can I buy a stock for $5? Yeah, I can. There's some out there. Can I buy a house for $5? And it's kind of hard, right? It's possible, but it's hard. Can a stock give me cash flow? Yeah, some of them give dividends. A stock can increase in value, and it can give me dividends. But what happens if my stock goes to zero? I'm totally out. I lost everything. If real estate goes to zero, and it never has, but if it does, I still have a tangible piece of land with a home on it that people want to pay me for. I can still earn income, even in the worst case of scenarios. I'm open to listening to anybody's methods about other asset classes, but real estate has served me very well over time, and this is why I do these presentations every couple of weeks. All right, I hope this makes sense, and I hope we're on the same page. And don't worry, at the end, you can ask questions and stuff, but I want us to go through the lending part of it. So that's the principal buy down. Lending, I need to know lending. In real estate investing, it is not like primary home loans. Okay, it is very different. The rate is important, but not as important as other things. Let me explain here. All right, there are two main loan types when it comes to real estate investing. And I don't mean like FHA and VA. That's not what I'm talking about. The loan types I want to describe, loan type number one. These are loans that come from Fannie Mae and Freddie Mac, if you recognize these names. Fannie Mae and Freddie Mac are government-sponsored agencies. So I just want you to understand in concept, these are government entities, okay? They have limits on how many loans I can receive, and the limit is 10. 10 is a good limit. Don't get me wrong, it's a limit, but if you have 10 loans, poor you. Oh, I have so many properties. This is a good problem. When you get there, it's a good problem, but it is limited. The other thing is that they have more rules, a lot of rules, sometimes really annoying rules, and they're hard to navigate, but if I can, I get some benefits from it. The other important characteristic of conventional loans is that they're based on me, like my income, my credit, my assets, my own personal stuff. The loan is in my name. That is a conventional loan. This is one of the types. Now, if I can play by these rules, I get some benefits, and the benefits are my rate is lower, and I have better terms. Usually, historically, this could change, right? It could over the next few months, but this loan type is one loan type, because there are people who come to me and say, hey, Andrew, I don't have any income, or even, Andrew, I'm at my loan limit. What do I do? This is what the other loan type is for. Loans that come from the lender's own portfolio of funds, their money. We call these portfolioed loans. Not loans that are based on your portfolio, but loans that come from the lender's own portfolio, like the money in their vault. It's their money. They can do whatever they want here. So Fannie and Freddie, I've got to go to them for their loan. It's their money. It's their rules. On the portfolio side, it's my money, my rules. Now, in theory, we should be able to be more flexible. We should be able to have as many loans as I want. I should. I should also be able to have less rules, should be. Now, although I might have a higher rate here, I might, because it's portfolio loans. And the other part of it, my terms might be different. I might have a 20-year loan instead of a 30. Just to be clear, a 30-year loan makes my payment smaller because it's spread out over time longer. A 20-year loan makes my payment bigger, which decreases my cash flow. One of those three areas that we make money on. I don't want to decrease my income. So if I have to use portfolio loans, I need to be aware that my rate might be higher, my terms might be different. These things are sometimes called, okay, the names that they give us, DSCR loans, bank statement loans, hard money loans are there. It's a form of portfolio lending. It comes from them. They get to set the rules. Asset-based loans, no income loans, whatever they want to call them. I want you to understand that it's their own money and that they can create rules that can help us. So in the previous scenario, what I was talking about, Andrew, I don't have any income to qualify for that first loan, conventional. I don't have any income. I show zero income. On the portfolio side, you need no income, at least usually. The loans that we want to work with, the lenders that we want to work with, they don't need any income. There's lots of portfolio loans. There's 8,000 different lenders in America. Some of them just aren't going to be good because they, hey, we only lend to gas stations. It's their money. They can do whatever they want. So how do we, as real estate investors, know which lenders to go to? This is the same mantra that I talk about for any vendor type. I need to lean on other real estate investors to give me guidance on who they're using. It's not foolproof, but if I go to the internet to try to find them, that could be a long time. I've had to call 200 different banks before looking for a certain loan product. But going to my real estate investor networking groups, I can get that loan type immediately, or a lot quicker. However, I still need you to ask some specific questions, even if somebody recommends a lender to you. All right. So this is the first concept I want you to understand, that there are two main loan types that you can choose from. And then the other concept that we're going to cover today are the questions that you're going to ask your lenders. And I want you to take a picture of this, ask these specific questions. We'll hit them one at a time and cover the right answers that they need to give us too. So question number one, this is for a conventional lender. The 7 questions you should be asking conventional lenders. When do you start using rental income to help me qualify? And the answer should be immediately. What I'm getting at, none of this, it needs to be on your tax returns. We have to have it for 2 years. No, none of that. And if you talk to a lender and they say that, you go to a different lender. There are lenders out there that need nothing from you. They'll just use it right away. I can even use rental income on empty houses. Yeah. So it's possible to do this. Ask that question. The second question, how long do you need me to be on title to refinance? I'll give them 1 day. If they say 1 day, that's okay. Anything over 1 day is not okay. And what I'm getting at here is seasoning. How much seasoning do you require? The answer should be 0, because Fannie and Mae and Freddie Mac say 0. Yeah, their own rules do. So if the lender is not following Fannie Mae and Freddie Mac rules, and they put their own rules on top of them, I need to go to a different lender. Ask these questions. What is your minimum down payment on a single family home? It should be 15% down. Even if you're not using 15% down, I want you to ask the question, make sure they answer it, because if they don't answer that question correctly, there could be other overlays, other rules that they had that you don't see, and you won't see them until it's too late, until you're into the loan process and it's too late to go to a different lender. Ask this question up front so you're protecting yourself. Can I change the title to the LLC? What is your loan minimum? Sometimes we look at investment properties that are very low valued. What's your loan minimum? Do you sell your mortgages? How many mortgages can I write with you? Andrew, I thought you just said it was 10. Yes, but not every bank will follow those rules. They'll put overlays, rules that are over the Fannie Freddie rules. It's annoying. This is why we ask these questions. Okay, take a picture of this. These are the concepts I want you to understand. There's different rules. and we're going to interview our lenders in different ways. The second thing here that I want you to be asking, what if I go to a portfolio loan? All right, let's ask some questions for these lenders. Take a picture of this. Is there a prepayment penalty? Yes, portfolio loans have a prepayment penalty usually, and many times it's a 3-year prepayment penalty. Like the first year will be high, the second year will be a smaller amount, and the third year will be a smaller amount. I can deal with it as long as I know about it up front. Maybe they have a 5-year prepayment penalty and this other lender has a 2-year prepayment penalty. It might make my decision different about who I'm using. Ask it up front so you're not surprised later on in the process. What is the term? Term means length. Some lenders will only lend a 15-year loan. That makes my payment so high. Ask them the term. We want 30-year. That's what we want to have. Is your loan fully amortized? Fully amortized means, is there a balloon payment? Like you're going to give me a 30-year payment, which makes my payment small. But if it balloons in 10 years, that means I've got to get out of the loan in 10 years. That means they call it due and I have to refinance or sell the property. Is there a renewal option? Yeah, again, this is a common thing in portfolio lending. Every 5 years, some loans have a renewal clause, which means the lender may not even renew your loan. You paid on time and they can still cancel it. So if this happens and you're caught off guard, like, hey, why are you getting rid of my loan? What, did you read it in your loan documents? Well, no, there was like 80 pages of that. How am I supposed to read every paragraph? Ask this question up front. You can't just discover this at closing. It might ruin everything for you. Ask these questions. Is there a release clause? Release clauses are for blanket loans mostly. So if I've got 2, 3, 5, 6, 7 properties under one loan, and somebody comes by and offers me an enormous amount of money for that one home, do I have to pay a penalty to release that loan, to release that property? Ask. Do you need me to personally guarantee the loan? Portfolio loans can lend to my company. Do I have to personally guarantee it? Ask the question. How is my down payment determined? On Fannie Freddie, it's like, hey, it's 15% down, it's 20% down. Sometimes on the portfolio side, they'll say weird math problems like, oh, it's 85% of the purchase price with 50% of the rehab, not to exceed 70% of the loan to value. What? And I'm not joking. That is their actual formula that they will tell you how to determine your down payment. So it can be a moving target with some places. If you have any questions about lenders of who to go to, get with me. I can share with you all the contacts that I've got, but ask these questions. How will my property be appraised for value? All right, in the portfolio side of things, it's 2 main methods. It's either sold comps, where the similar properties that are similar to my home, what have they sold for? Or the rental income, like the property rents for this, and therefore the value is this. Yeah, it can be totally different. So how, when you are analyzing your properties about what to make your offer on or what they will be valued, how do you know which way they're going to do it? You need to ask it up front. Very different loans, they go with different purposes. And even if, I want to get back to something here real quick. So let's get back to the loan types, right? So Andrew, I've got great credit and good income. I don't think I'll ever need a portfolio loan. You might find a great property, my friend, that is just weird and different. Hey, I found this property, cash flows amazingly. It's 3 homes with a cabin. Fannie and Freddie are not going to touch that. You may need portfolio lending just because the property works. All right, so don't miss out on cash flowing with a great property because you don't have lenders in your toolbox. If you're just starting out, I need you to have 4. 4, yeah, and the more successful you come, the more lenders you're going to need. I probably have like 30. Yeah, I've got a lot. You'll need that someday too. But in the beginning, I just want you to understand what loan types we have as our choices and what questions to ask. Hey, as always, the Drew 2, right? We fly through this. It's already over. We're almost at 22 minutes. These are just very brief meetings to give you some concepts of what to look for so you understand a little bit better. I'll let us ask some questions here shortly. In 2 weeks, though, I'll be giving my next presentation on how to make $100,000 a year buying fixer-upper rental properties. I'm not joking. I'll show you the math. This is exactly what I do and what others do too. You're going to see exactly how we make $100,000 a year buying fixer-upper rental properties. And there's never anything to buy here, guys. Nothing. I'm not selling anything. I just want to give out good information. Took me 20 years to get where I'm at. Nobody taught me a thing. Hopefully some of this information can help. So, one thing else I wanted to share with you. So even though we covered this for 22 minutes today, I am speaking about loans for an hour at a real estate group coming up. Let me see where the chat room is here. Here we go. This is online and in person. If you're in the Dallas-Fort Worth area, this is not my club. Okay, I'm a guest speaker, but we're going to talk about loans for a longer period of time, more interactive. You can meet people, other investors, that sort of thing. And it's online too. If you'd like to go to that meeting, you can. All right, now I've got a couple of things in the chat room. Oh, thanks. What market am I in? Yeah, I'm in the Dallas-Fort Worth market. It's expensive for investors. Everything is expensive right now, and it's not slowing down on the expense. Interest rates are high. There's lots of challenges for us as investors. Again, I invested during 9/11, housing crisis. Today, there's specific strategies on what we need to do right now. I can certainly call me. We could talk through some of these things together. I want to give everybody an opportunity to unmute and ask any questions. Do we have any questions we'd like to address today? Cool. No problem. Even if you have a question you don't feel comfortable asking, my email is on the screen. Follow me on Facebook and Instagram. Every 2 weeks, 22 minutes, and then you get right back to your daily routine. Thanks everybody for being a part today, and we'll talk with you soon.